Welcome to vTalkInsight, Market Drivers Daily for May 4th, 2026. Oil above $110, an AI-powered equity boom, and a jumpier rates market are pulling portfolios in different directions today. Let's dive straight into how geopolitics and energy are setting the tone. Geopolitics and energy remain the primary macro anchor, with the Strait of Hormuz still the key pressure point. Brent is holding above $110 a barrel after repeated reports of attacks and contested control claims, and physical markets are trading at strong premiums to futures, signaling persistent concern about prompt supply. Compared with last week's move higher in oil that was already the central macro story, today's tape shows that elevated prices are becoming entrenched rather than a brief shock. The economic transmission is becoming clearer and more uncomfortable. If crude averages $100 in the current quarter, estimates suggest headline GDP growth could be shaved by about 0.4%, and scenarios where Brent spikes toward $130 or even $150 would imply much larger hits to real incomes. Airlines have already cut millions of seats, and unhedged U.S. carriers are seeing margins squeezed by sharply higher jet fuel costs, with Spirit Airlines' collapse and Norwegian Cruise Line's guidance cut, illustrating how quickly energy shocks can morph into credit and earnings pressure. Regionally, Europe and parts of Asia remain most exposed. Europe faces a stagflationary mix of weaker growth forecasts and rising inflation expectations, driven by the energy shock and ongoing conflict in Iran, even as policymakers lean toward further rate hikes and higher defense spending. Asian economies that depend on imported energy are facing demand destruction as elevated oil and refined product prices, up significantly since before the war, bite into consumption and travel. Layered on top, renewed U.S. tariff threats on European autos and China's instruction to ignore certain U.S. sanctions on Iranian oil-hardened trade fault lines, just as the region grapples with energy dependency. Policy and market expectations are being pulled in two directions. On one hand, some forecasts still see Brent easing back toward the low 80s by year-end, especially if a ceasefire plan and shipping corridors in the Gulf gain traction, or if producers like the UAE eventually add supply. On the other hand, persistent blockade risk, strategic reserve depletion, and the possibility of further supply losses keep open scenarios where oil remains well above $100, complicating central bank plans and reinforcing a higher-for-longer rates profile. Yet risk assets, particularly U.S. equities, continue to trade close to highs, suggesting geopolitical tail risks and the recession potential from prolonged energy shocks may still be underpriced. The immediate watch points are any concrete progress or setbacks around shipping security in the Strait, signals on secondary sanctions for Chinese banks or refiners, and how European policymakers balance higher rates with targeted fiscal support. If the energy shock persists into the second half, the growth drag and inflation impulse are likely to collide directly with today's narrow, AI-led equity strength. That takes us to the second major driver, the AI engine that is still doing most of the heavy lifting for global growth and equity performance. Artificial intelligence remains the dominant story on the growth and equity side, increasingly overshadowing traditional macro concerns. Recent U.S. data suggests that AI-related investment contributed around 1.5 percentage points of a roughly 2% GDP growth rate, and AI-driven capital expenditure has overtaken consumption as the main growth engine. Enterprise spending on large language models is reported up multiples year on year, while hyperscalers have posted around 25% revenue and 60% earnings growth on the back of AI deployment, reinforcing expectations of a multi-year capex cycle. This strength, however, is extremely concentrated. U.S. equity indices sit near records, yet the average S&P 500 stock is notably below its high, and consumer discretionary names have lagged, highlighting that AI and semiconductors are masking broader fragility. Investment outside AI has been crowded out in recent years, leaving other sectors less robust if AI momentum slows, and private equity portfolios remain heavily exposed to industries vulnerable to AI disruption after peak 2021 entry valuations. Globally, Asian tech and hardware names, from Korean memory makers to Taiwanese foundries and European chip and telecom equipment stocks, are riding the same AI wave. On valuations, the picture is nuanced rather than uniformly stretched. Some AI hardware leaders are backing sharp share price gains with extraordinary earnings growth, as seen in recent results where profits surged many-fold, keeping multiples more defensible. At the same time, rising AI capex is increasingly financed by debt for certain megacaps, and credit spreads remain tight partly because investors expect AI-driven productivity to support margins. Central banks, though, are skeptical of using future efficiency gains as a basis for today's easing. Arguments that AI will soon deliver disinflation and justify rate cuts are still viewed as speculative. AI is also reshaping geopolitics and capital allocation well beyond software. The US and China are both racing to embed AI in defense and state-owned enterprises, turning compute, power supply, and data into strategic assets and reinforcing themes of technological sovereignty and supply chain rewiring. Demand for high-power data centers and advanced manufacturing sites is lifting industrial real estate and exposing bottlenecks in power grids, while unconventional infrastructure, such as offshore compute projects, underlines the belief that demand for compute will not plateau. For credit markets, this capex surge is creating sizable investment-grade lending opportunities in chips, power, and defense, even as a higher volatility regime makes senior positions relatively more appealing than equity in some cases. The key risk remains a sudden shift in the AI narrative. If enthusiasm fades, either because of regulatory pushback, slower than expected monetization, or a broader growth shock from energy and rates, today's narrow leadership and elevated valuations could face a sharp correction, especially given how much economic momentum is riding on this single theme. For now, the tug-of-war between AI optimism and macro headwinds is breaking in favor of AI, but the cushion is thinner than headline indices imply. That fragility feeds directly into the third strand of today's story, a higher volatility regime that is increasingly hard to ignore. Market action is pointing toward a structurally higher volatility regime rather than isolated spikes. Light liquidity today, with several major markets on holiday, is amplifying intraday swings as contradictory headlines out of the Middle East drive sharp moves in crude and quick reversals in equities. Compared with the constructive tone that prevailed before recent Gulf headlines, the ease with which risk assets flipped to risk-off underscores how fragile conviction has become. Under the surface, demand for protection is building. Pricing of S&P 500 put options has become more attractive as skew declines, and investors are increasingly using index hedges to balance exposures to AI-heavy benchmarks and energy-sensitive sectors. At the same time, there's a growing view that markets underestimate the probability and impact of tail risks, whether from geopolitical miscalculation in the Strait, policy error in response to stagflation, or unexpected losers from rapid AI adoption. That perception is reinforced by tight credit spreads and low distress signals, despite mounting evidence of stress in areas such as airlines and select energy-exposed credits. Rates and liquidity dynamics are adding another layer of complexity. The 30-year U.S. Treasury yield, hovering near cycle highs, has become a key barometer of stress as concerns about energy, deficits, and refunding plans feed into long-end volatility. Heavy reliance on short-term Treasury bills increases rollover sensitivity in any future bout of risk aversion. In private markets, higher volatility and slower exits are challenging the promise of steady returns and liquidity, with retail flows into private vehicles at risk and some large managers holding significant dry powder in anticipation of more attractive entry points after a correction. Corporate activity is being reshaped as well. Shareholder activism, including high-profile campaigns at companies like eBay, signals a willingness to use governance tools more aggressively in a world where organic growth is narrow and capital allocation is under intense scrutiny. Mergers and acquisitions are up year on year, but the combination of geopolitical uncertainty, energy volatility, and AI disruption is preventing a decisive step higher in deal-making. From here, key triggers for the volatility landscape will be the next U.S. payrolls report, any shifts in central bank communication around oil-driven inflation, and whether AI earnings and guidance continue to justify current equity concentration. The picture today is a three-way tension. Persistent Middle East risks and triple-digit oil are pushing the global economy toward a slow-burn stagflation scenario, especially in Europe and energy-exposed sectors. At the same time, An exceptionally concentrated AI investment boom is carrying much of the load for growth in equity returns, while also raising questions about sustainability, funding mix, and policy response. Overlaying both is a shift toward a higher volatility regime, where tail risks around geopolitics, rates, and technology adoption matter more, and traditional assumptions about safe havens are less reliable. Watching how those three forces interact across oil curves, long-dated yields, AI earnings, and hedge demand will be critical for risk management over the coming weeks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.